The Climate Action Reserve is the most experienced and trusted offset registry to serve the carbon markets. As more organizations look to combat climate change and support environmental projects with true integrity, they turn to the reserve to foster real solutions and reductions in greenhouse gas emissions. We are excited to kick off the second series of Carbon Connection and feature external partners with insights and expertise in particular climate sectors and topics across the carbon market. I am your host, Lauren Napuk, and thank you for joining us. Hi, welcome to our next episode of Carbon Connection. Today, we are speaking with Luke Oliver, Managing Director, Head of Climate Investments, and Head of Strategy at KraneShares. Luke leads the KraneShares Climate Solutions business, building innovative products that provide access to unique markets within this growing investment universe. In addition to curating the firm's climate, carbon, and impact strategies, Luke works closely with clients to educate them on the asset class and client implementation strategies. Today, we are speaking with Luke about the critical role financial institutions play in solving the climate crisis, driving capital flows into carbon markets, and much more. Luke, thank you for joining us.
Thanks, Lauren. It's great to be on.
Thank you. Now, Luke, to kick things off, what are some of the financing challenges facing today's global carbon markets?
Well, I mean, the challenges run across the board. I think there's two main areas of challenge that spring to mind. The first one is we're just moving too slow. I think we all acknowledge that we're not moving fast enough. We need a lot more capital flowing to the right places. And we need to create the economic environment that it makes sense for people to allocate capital. I'll touch on this more, but not just do good. We need this to make economical sense. And that's how things will really accelerate. The second side is the other, you can hear by my accent, I'm from the UK, but I've lived in the US for about 19 years. And when I am on the road talking to clients about carbon, it's very polarizing. It's what is this woke nonsense you're talking about? And this is socialism. However, people come around to these notions. And so I think I've got good at walking on this tightrope of not really saying anything that could be considered woke or saving the planet or saving the dolphins or whatever these people are frightened of for some reason. And I'm just very good, I think, of explaining to people why this is an economic opportunity created by the global decarbonization cycle that is happening. And whether you like it or not, this is happening. But to your point, the question was, what are the challenges? The challenges is we've got a considerable portion of people that control capital who are not convinced that there is a problem that needs to be solved. And in fact, they think that the work being done to solve the problem is in some way a false economy or not appropriate allocation of capital. So that's a big challenge. And that's really mainly a US thing. Whereas the first element I mentioned was a global thing, which is that even those that do recognize the problem are very slow to move.
Thank you so much, Luke. You raise really important issues that we're facing right now across the market is that having this slow to move process of actors, as well as ensuring that we're moving this capital to the appropriate places. And financial institutions play a really critical role in moving this capital. I'm wondering if you can dive into this a little bit more about the role financial institutions are playing in carbon markets to really minimize the impacts of climate change.
Well, I mean, that's our job. And financial institutions, whether you are, sort of sell side and lending money to folks, or as an asset manager, raising assets from investors and allocating them to investments in the climate space or the sustainable or green space, pick your word. That's our job. And we do that from an asset management side, with a fiduciary. We have to be making the best use of our clients' funds. And we strongly believe, in our case, that the compliance carbon market, and as we move along, I think, we'll see the voluntary carbon market in the same way. And if you wonder why I kind of put them in that order, we've raised about 800 million in compliance carbon funds. We've raised less than 20 million in voluntary. Just to give you an idea of the sort of client interest that we've had. However, we're bullish both of these markets. We think both of them will grow. That voluntary maybe has the most upside, but with the most risk. And, you guys are very familiar with what I'm talking about there. But on the compliance side, we think that's the first step to get investors into the carbon markets. We think it should be in every portfolio. We think that you need to be allocated carbon because your portfolio arguably is short carbon. And so it's also a lot easier because there's a lot less risk. If you put yourself in the mind of an investor rather than a climate activist, an investor wants to see standardization, they want to see liquidity, they want to see regulation and all the sorts of protections that you get with an equity or a bond. Compliance carbon looks a lot like that. So for us, that's the lowest hanging fruit. Let's get the market pricing compliance carbon. And then, we move on then to more the frontier markets. Basically that's, there's the answer. What is the financial institution's role here? It's put this in capital speak, put this in investor speak. And that's what we do. We take this new market, this new asset class, and we translate it into a product, both structurally and in the way we talk about it, that an investor would allocate capital to. And while you might argue the financial institution isn't as important as the person in the field with the boots on, planting and preserving trees. I think we're doing something really important. And you could argue that without those capital flows, none of this works. So we take a lot of pride in translating something very complex and new to something that the average investor might put in their portfolio. And we're seeing great progress with that.
Thank you so much, Luke. That's really important, the role that they're playing, because without these financial institutions, there might not be this push that the carbon market is really seeing right now. So I appreciate that. And talking a little bit more about capital and financing, where is climate financing coming from and where is it being invested in right now across the carbon market?
Yeah, well, so there's lots of different sources of capital and there's lots of different places to allocate that capital. And something I spend a bit of time talking about is the impact that compliance carbon has. You have the auction, which raises a war chest, if you like, for whether it be the European Commission or the California Air Resource Board to spend on initiatives. Then you get this mechanics of fuel switching. So if you're burning coal and because of the cheapest fuel, well, suddenly you've got to buy more carbon allowances for burning coal than burning gas. So it becomes economical to switch to gas. You get these just natural, the invisible hand of the markets coming into play. And then the third one is that by putting a price on carbon, on capturing carbon or reducing carbon output, and now that there's value in doing that, there's a whole arms race to developing technologies that can do that because you can make money doing it now. So that's why we think that the compliant price on carbon just creates the landscape that all this other capital flows into. So I really like that. So by creating the right price of compliance carbon, one, you have an effect on the price of voluntary carbon, very detached and different today. But at some point, this is a big debate that people have, but at some point, there's no way these things don't much further down the road start to converge because we'll get to a point where the compliance markets can't lift anymore and we're going to need to offset the remaining. So there's going to be something there. But I love this idea that by putting a price on carbon, you catalyze billions of dollars into innovation that isn't directly attached to the people buying the allowances, but it's the monetizing of that price on carbon. So that to me is incredibly important because it engages all of your traditional financiers. And then you look at there's various research. I think, IETA might have a number on it. I think McKinsey has a number on it. And they range from 140 trillion to 250 trillion between now and 2050 to decarbonize the global economy. So just by setting this thing in motion is just a capital cycle of epic proportions. And you know what? Humans are really good at engineering. And so once this capital is in flow and people are incentivized, I think we're going to create some miracles. People are going to be really surprised, fingers crossed, at how easy we might solve some of these problems. But like anything, to get someone out of bed and to do it, you got to pay them. And so that might sound very capitalist. It's just the reality. So the money will come from everywhere to everywhere if you create the right environment for it. And that's what a lot of the carbon markets are trying to do.
Thank you so much, Luke. That was really helpful for understanding. And you're absolutely right. There's lots of different mechanisms are out there in the market now, and lots of end users that need to see the capital coming to them to really make the largest climate impacts that we can within the market. So I really appreciate that. And with the carbon market, we have been seeing a lot of evolution and changes happening over recent years. And I'm wondering if you can share a little bit about how capital flows into carbon markets has also changed in recent years. And what is the significance of this development of capital flows into carbon markets?
Yep. I think the obvious one is, and probably why we're having this conversation is that financial institutions have got involved. And I speak to lots of people who it's kind of a bittersweet thing for a lot of folks that have been in these markets for 20 years, and suddenly people like me show up and they're like, oh, come on, we've been doing this for 20 years, and now you guys come in and you're raising money, and these people are raising money, and this startup is starting over here and there. But it's important. So it's like I say bittersweet because it's what they always wanted, but it's also challenging when everybody else figures out what you figured out 20 years ago. And so we're going through that at the moment, and it's incredible credit to the people that did it for so long and got it to where it is. So there's more financials involved. And I think generally that's good. But I also think that there's a challenge in the fact that we also see these markets get very hot and then they blow cold. We've seen that in the voluntary market. I don't know if we're on the second or third cycle of that. Compliance markets, we had raised nearly $2 billion in about a year and a half. And the following year and a half, we've seen half of that go out. And that's frustrating because we'd rather see all of these markets growing steadily and stably rather than hot money in and out. But that's also part of the game. You get that in every other part of the economy. And so we have to learn to deal with that. So that's what I think's changed. I don't like the hot money element of it, but that comes with real capital flow. So I'm okay with that. But I think that's significant. And what you always get with any big hot money flow, when it goes back out, it's almost like the tide comes in. And when it goes out, it leaves rock pools behind. 2 billion can come in, but only a billion will go back out. And the next time 2 billion will come in and we'll keep another billion and we'll get there.
Thank you, Luke. I really appreciate that. And another topic right now that's hot within the carbon market is high quality credits and ensuring that the credits out in the market are of the highest quality, that they're transparent, they're accessible. And I'm wondering, what is the importance of high quality credits to financial institutions?
Well, this is an interesting one because I think this speed at which financial institutions have come into this area, I don't think everyone has appreciated. So we pride ourselves at KraneShares on really knowing what we do. We were very focused on investments in China. I think we're the leading investment firm in China research and knowledge. And we didn't want to enter this space. So me and the team here we know this inside and out. But one thing I don't think is appreciated enough is when you say high quality credits, what that actually means, because I've tried using analogies. Maybe fixed income is better than equities for making an analogy about what a good credit is. But it's more complex than that because it's not two-dimensional, three-dimensional. It's like seven-dimensional because you've got how long is the carbon being stored? How long are there co-benefits? Is there biodiversity as part of that? You've got the SDGs. Like, how many different dimensions is this thing quality? And often something is regarded as quality, but how robust it is at holding the carbon might not be as great, but there's amazing biodiversity benefits. Just to use one dimension of the example. But so understanding all of those elements. And then I also see a lot of people buying offsets and saying, oh, I'm buying these. They're really cheap. I'm going to hold these forever. And they don't understand that the older the vintage gets, there's some decay. There's a conversation I've had with a lot of finance folks is that we need to bring some financial pricing modeling to this asset class. And it's not that, the people that were already in the commons didn't recognize that, but we all think about cost of carry and decay and things like that. It goes in a lot of directions here. So what I think is really important, high quality is a tough word because it means different things to different people. What I think is really the top level thing that's important is, will this carbon offset be respected in the future is the big challenge. That's a very simple way to say it. People are worried. So I think there's a lot of people on the sidelines because they're not sure that what they buy that sounds amazing will be considered amazing in a few years' time. And we've seen that happen. So it's very important, but defining high quality. So I think someone needs to, and I've got an idea on this and happy if anyone wants to work on this with me because it needs to happen, is creating some sort of, it's almost like a pricing surface where we need to have, and I've disagreed with this with some carbon folks on panels and things before. People say, well, a ton is a ton is a ton. But I think that's part of the problem. They're not, because a forest that had a 10% chance of being cut down, but it's still is a ton of carbon recorded there, is very different from a commercial building reducing their emissions by selling offsets to then put solar panels on the roof and reflective windows and things. There's a different, in option speak, we talk about delta, like how in the money or how likely is this option to be in the money. I think you almost need that mechanism for offsets. And it's not necessarily a measure of quality, but it's just saying how much of that ton, how do we count? So I would argue then, but I've had people completely disagree with me on it, and that's okay. We can figure it out. But I just think if something is worth a real ton, right? You buy that and you know that 1 ton, because of you purchasing that, was captured or stopped going into the atmosphere. That feels like 100 delta. That's a real ton. Something that is preserving forest, also incredibly important, but it might be a 50 delta, as in it's not worth a full ton because it's not that likely to be cut down, but there is some chance. And if we don't save that, maybe it will get cut down quicker. And who knows? Like it's hard to assess this in every possible direction. But if we can't agree on what's quality and if we need something to help us connect all the different offsets. And I think that sort of ratio might be a way to do it, that this ton is a full ton, but there's no co-benefits. This one is kind of like a half ton, but look at the incredible co-benefits that come with it. And so there's no good or bad. I just think it might be that you could buy the cheaper allowance, but you buy 10 of them instead of the more expensive allowance. And I think that ratio to equalize each ton is important. That's my take on it.
Thank you so much, Luke. That was really helpful. And you raise key points and challenges that the market is facing right now, which is finding clarity across these definitions and having common understanding for what some of these things mean across the carbon market. So I really appreciate that. And what are some challenges to upscaling the amount of finance that's needed to combat climate change? And how can the world galvanize this capital needed for
Yeah.
climate
Well,
beneficial investments?
yeah. And this is the key question. So the first part, what are the challenges? Well, I think the challenges go away when people start to make money. The risk is when you have these hot money flows and people chasing performances, people have bad experiences and they say, I'm never getting into that again. And that's a problem. And we know that's happened as a little bit, right or wrong, but it's happened. And so people have had that experience, and that's a big challenge. But when people make money, they show up again and again and again. So we need to create the framework where people have good experiences and true experiences. And then I don't think you have any challenges and the money will flow. But how we galvanize it, this is the thing that, and this is where I keep pretending to be a cold-hearted capitalist. But the reality is we need regulation and we need incentives and governments need to, these decisions don't happen fast enough if you just leave the markets to it. So, but that's also why I like carbon markets, because they're kind of a hybrid of governance in that you're putting a price on something and you're creating a structure for people to reduce their emissions. So there's a regulatory, especially in compliance element to it, but then you're letting the free market work from there on. So I like that hybrid because it's not efficient to tell people what to do and what they can't do. But if you make the incentives right, it'll work. So a global compliance price, it doesn't have to be the same price everywhere, but just compliance markets covering 100% of global emissions will be a huge accelerant to galvanizing the world behind this. And so it does take regulation. It does take, you can't rely on free markets entirely, but you can use this hybrid. And the compliance markets will drive the voluntary markets because I think that ultimately, like I said at the beginning, the compliance markets should be used to clean out all the low hanging fruit up to a certain level. And then beyond that, there'll be things that are just, let's say carbon compliance, right? Our blended average in our fund is about $50 a ton. Carbonomics puts the number at $1,500 a ton to decarbonize the whole global economy. So that's not a realistic number. And that would do more damage to the economy. we'd have no pollution, but we'd have no jobs and economy. So we need to find that middle ground. And so let's say carbon gets to a couple of $100 to $300 a ton by 2030 and beyond, big number. But what that should do is create the innovation that flattens that curve. And for the rest, that's where the offset markets will come in and get us that last mile or the last 50% of the way. I don't know exactly where that breakpoint is, but the two things are needed. So yeah, I think we're going in the right direction, but a little bit too slow again. But ultimately, pricing carbon is what will accelerate this and galvanize corporates, consumers, governments behind decarbonizing. You know, going back to this kind of criticism sometimes that I hear, this isn't about putting friction into the economy, into businesses. Humans are great at this. We've optimized every single thing we've done except how much CO2 we put into the atmosphere because that was free. So you put a price on it, people just suddenly say, oh, okay. Oh, I have to pay for that now? Fine. I'm going to not do it anymore. And we're going to start planning and we're going to optimize between how much it costs and how we reduce what we do. And we're good at that. And it just creates another wave of opportunity for smart people to succeed. I think it's great. I think it's the opposite of throwing sand in the gears. It's giving a new opportunity to a new generation of people to innovate.
That's really inspiring, Luke. I appreciate you sharing that sentiment because you're absolutely right. I mean, climate change is not going away. It's something that we're seeing only impacting people going forward in the future. So being able to get all hands on deck and people involved in offsets and accounting for carbon emissions is critical. Look, before we close today, which I want to thank you so much for your time, I did want to ask if you have any final thoughts or comments to share with us that we might not have addressed today that you want to share with the audience.
All I would add is that KraneShares, we're out there. We've got compliance and voluntary products. We're doing a lot of other interesting things in the space and working with some great partners. So we'd love to hear from people that are interested in the space and certainly can help people with their investments in the carbon market.
That's great. Thank you so much, Luke. I really appreciate all of your time today and your expertise across financial institutions. And thank you for joining us.
Thanks, Lauren. Have a good one.